inflation over the past 2.5 years, supported by the restrictive stance of monetary policy. Domestic price and wage pressures have generally continued to abate in recent months, and that's allowed us to take another step today in reducing bank rate. But the picture is more complex than that. Headline inflation rose to 3.6% on the latest data for June, owing to increases in energy, food and administered prices. Now, we have been expecting this move up. Indeed, I referred to it at the last press conference we had in May. We think that inflation will increase to around 4% in September. Our job is to ensure that inflation falls back to the 2% target once these temporary factors pass, as we expect to see. So it remains important that we do not cut bank rate too quickly or by too much. Today's decision is based on 3 key judgments on the outlook for the UK economy and inflation, and our assessment of the risks around those judgments. So I'm going to set out each of these key judgments in turn, and then I'll conclude with the implications for monetary policy. The first key judgment is that disinflation in underlying domestic price and wage pressures is generally continuing, albeit to different degrees. Headline inflation is likely to pick up slightly further in the coming months, but we do not expect this increase to persist. Chart 1, which has just come up, shows the development of 12-month consumer price inflation since 2021, that's the white line, along with its components, which are the coloured bars. The largest driver of the rise in headline inflation over the past year has been energy prices, which are no longer pushing inflation down. You can see that in the orange bars, while the contribution from services price inflation, which is the yellow bars, has remained elevated. More recently, higher food price inflation has also contributed to higher headline inflation, and that's the purple bars. In the shaded area, the chart shows how we expect headline inflation to peak at about 4% in September. In addition to the contributions from energy and food prices, inflation will continue to be held up over the coming months by a number of increases in regulated and administered prices, such as water bills and vehicle excise duty, that are not directly linked to underlying cost pressures in the UK economy. There are good reasons to think that this rise in headline inflation will not persist. Now, as chart 2 shows, excluding the impact of administered prices, there has been some further progress on disinflation and services inflation. Inflation in services prices that is more directly linked to cost pressures in the UK economy has therefore continued to ease, albeit gradually. And pay growth, a key component of cost pressures in the UK economy, has declined further recently. Annual private sector regular pay growth, shown in chart 3, that's the purple line, if you can detect it in the many lines, was 4.9% in the 3 months to May, about half a percentage point weaker than we had expected in the May report. Now, this is in line with a range of other indicators also pointing to a gradual slowing in pay growth. Annual pay growth is likely to ease further over the second half of the year. That's the purple diamonds. Intelligence from the bank's agents continues to point to average pay rises for this year of between 3.5% and 4%. That's the green dot. And the bank's decision maker panel expects pay growth to be just under 4% by the end of the year. That's the slightly hidden yellow diamond. We should expect this gradual normalisation in pay growth to feed through to lower services price inflation as we look ahead. But the risk that the recent rise in prices could feed more inflation, as illustrated in the inflation persistence scenario that we set out in the May report, has come into sharper focus. Higher food and energy price inflation and some additional pressure from other components has increased the peak in headline inflation we expect in September by about 0.3 percentage points compared to the projection we had in May. Food and energy prices are salient to consumers and often affect inflation expectations more than other prices. So we have to be very careful that this does not lead to any additional second-round effects on wage and price setting in the economy. The slight increase in the upside risk to inflation makes the second and third key judgments underlying our decision today all the more important. And these key judgments have not changed since May. The second key judgment is that a margin of slack has opened up in the UK economy and the labour market is continuing to loosen. While we expect it to pick up a little in coming quarters, growth in the UK economy remains subdued. Employment growth is weak, and the ratio of vacancies to unemployment has fallen further. Surveys of capacity utilisation suggest growing spare capacity within firms. And here, risks are more to the downside. While real household incomes have risen over the past couple of years, consumption has not followed suit. The saving ratio remains notably above pre-pandemic levels, and we have for some time been expecting it to decline and support consumer spending. Consumers appear to remain more cautious than we have expected, perhaps exacerbated by broader downside risks to activity and the risk of more sudden adverse developments in the labour market. Now, the third key judgment is that the margin of slack will act against remaining persistence in domestic price and wage setting to return inflation to the 2% target in the medium term. While inflation is somewhat higher in the first 2 years of our August baseline projection than in May, a margin of slack in the economy helps fully to normalise pay and price setting dynamics in the medium term. Accordingly, as chart 4, which has just come up, shows, conditional on the market implied path for bank rate, inflation returns to the 2% target in the second quarter of 2027 in our baseline projection and remains at target thereafter. There are risks on both sides of this projection. The extent of the shift in global trade patterns and how this may come to affect external pressures on UK inflation remains uncertain. Recent domestic news suggests that the risks to inflation have shifted slightly more to the upside. The near-term peak is likely to be a bit higher than we previously expected, and the risk of second-round effects means that it may take somewhat longer for inflation to return to target. But at the same time, there are slightly more risks on the downside to activity. Economic growth is subdued, the labour market continues to loosen, and consumption growth may take longer to pick up. That in turn could lead to inflation falling below the 2% target further ahead. So, do we put more weight on the recent pickup in inflation and the risk it poses to inflation persistence, or do we put more weight on the risk that the recent weakness in activity could lead to inflation weakness further out? Well, the answer is that we set monetary policy to reflect our assessment of the balance of risks, and we set monetary policy in a forward-looking manner to return inflation to the 2% target sustainably over the medium term. That sometimes means that we will be able to look through developments that we think are unlikely to last. But we stand ready to adjust our course if we see shifts in the balance of risks to the medium-term outlook for inflation. And we will do what it takes to return inflation to our 2% target. At this meeting, the Monetary Policy Committee judged that a further 0.25 percentage points reduction in bank rate was appropriate. Based on the outlook for inflation, a gradual and careful approach to the further withdrawal of monetary policy restraint remains appropriate. The restrictiveness of monetary policy has fallen as bank rate has been reduced. The timing and pace of future reductions in the restrictiveness of policy will depend on the extent to which underlying disinflationary pressures continue to ease. Monetary policy is not on a preset path, and the committee will remain responsive to the accumulation of evidence. So with that, Dave, Claire and I will be happy to take your questions. Thank you.
We'll go Maureen and then Richard.
Hello, Mehreen Khan from The Times. I think this is probably a question for Claire because you voted to hold rates. So what is your threshold for cutting rates again this year? Do you need to see material evidence of more disinflation beyond what's in this forecast to argue for another rate cut? And given that food price inflation is very important in this forecast because it has surprised you, is there not a danger that by keeping rates restrictive, again, maybe to Claire, that you're just worsening the cost of living pressures that British households are already facing with higher energy, utility and food prices?
Sure, thanks. I mean, today we're talking about the sort of policy decision taken by the whole of the committee, and the information that we're putting out today. There is a paragraph in the minutes that sets out my view and the views of the others who preferred to hold rates constant. I'll also be setting out my view in a lot more detail later. I'll be before the Treasury Select Committee the first week of September, and I'd be very surprised if this isn't a subject of discussion then. So I'll talk a bit more about that then.
Richard?
Thank you very much. Richard Partington from The Guardian. How much of an impact is government policy having on this higher inflation position and the reach to 4%? You're talking a lot about food prices and how there is a contribution there from the employment tax increases and packaging changes. But there's also an impact on unemployment. I mean, does it now appear there's more pass-through on prices than the impact on jobs? And then the Chancellor has said today that government policy has returned stability to the economy and made it possible for the bank to be cutting rates. I mean, but are you not saying today that the government has made things harder if it is adding to inflationary pressures?
Well, the thing I would say, Richard, to that is that as the report sets out, and as you'll see in the box that we've included on food prices, which goes into food prices at some length, there are quite a lot of contributions to this. So there's a lot of smallish contributions to this that make it up. Some of those are global. Energy, for instance, is predominantly being affected, obviously, by global developments, of which there have been a lot. A good part of the food price story is to do with commodity prices, and a good part of that is commodities which are not produced in this country. So coffee and cocoa would be cocoa beans would be an obvious case in point. There is an element of, as we've said, of administered, domestically administered, that is, price effects in here. So water bills, vehicle excise duty, packaging tax in the food industry, which we again do describe in the box. Now, it's obviously a little bit hazardous to try to sort of pass those out exactly, but I think it's a little bit under half in each of those two, probably. I don't know, Claire, you want to come in on that?
Let me talk a bit about food, and also it picks up the Maureen's point as well. I mean, look, on food prices, so food price inflation went up 4.5% in June. Right, there was some news in that for us. We did expect it to go up. We didn't expect it to go up quite as much as it did. I mean, that's obviously considerably higher than the sort of pre-COVID average of 1.5%. Now, a lot of that is driven by global factors, and you can see we've shown how this food prices in the UK compared to in the EU, and you can see it's the same sort of pattern. A lot of that is about commodity prices, agricultural goods. As Andrew said, we've seen particular pressures around things like beef, butter. A lot of that is about feed. Some of this is driven by weather events, extra rainfall or droughts or particularly dry periods. So a real mix of things that are going on there. We're also seeing changing in the pattern of demand globally as well. So it's not just that. So that's sort of the majority of the change that we've seen in food prices. There is an element that is some of the other factors, packaging, labour costs and all that. I mean, we expect food prices are going to carry on rising. Actually, sort of we've got in our short-term forecast 5.5% this side of Christmas before falling back, and we would expect them to fall back as these cost pressures fade, global wholesale factors fade. I mean, look, the reason we look at this carefully, and this picks up the previous question, is sort of twofold. One is it's a large part of the basket. You saw in Andrew's charts, this is 11% of the CPI basket. It's obviously more than that for people on lower incomes, and comes after the sort of cost of living pressures that we've seen. It's also particularly has a particularly salient role in inflation expectations. We know that people notice it more. Alongside energy, food is the most salient part of inflation that people notice. And therefore it affects their experience of inflation, but also their expectations of inflation. So it's something that we're focused on, and as Andrew said, we've put a box in the NPR talking a lot more detail about this.
We'll go to Faisal right behind you, and then Gurpreet.
Faisal Islam, BBC News. In your statement, Governor, you said that interest rates are still on a downward path. Are they definitely still on a downward path?
Yes. What I would say, Faisal, on that is that I do think the path continues to be downward. there are all sorts of, I mean, we've included a box on restrictiveness. There are all sorts of views on where the neutral rate might be. I'm in the camp of people who sort of thinks that's rather too uncertain to speculate on, but I think it's very important to sort of talk about, you know, the whole idea of restrictiveness, and we've put a lot in there about how we assess it. And I do think, you know, policy is still restrictive, even when we say we're past the peak. Of course, that's a comment on, if you like, on the level, as it were, and that, you know, not the direction might be sort of be less restrictive, but the level can still be and is still restrictive. So I do think that. What I will say, and you saw it in my opening remarks, I hope I heard it, is that there is, however, genuine uncertainty now about the course of that direction of rates. I'll be honest with you, that's the point I was making, is that I think that the path has become more uncertain because of what we're seeing. You know, we're telling a story here, really, that we've got an upside risk, which is really a sort of can be more directly mapped into inflation. It goes to the previous two questions, actually. But we've got a downside risk, which of course gets to inflation via, weaker activity, weaker labour market story, and we are balancing those two risks. Now, I think the path has become more uncertain, but I don't think, I certainly have not changed my view on the overall sort of, if you like, direction of the path. It's a question of, how uncertain it is, and therefore, over what course of what period of time it takes.
It's Gurpreet right in the middle there, yeah.
Thank you, Gurpreet Narwan, Sky News. I noticed from the minutes that one member of the committee said that they were worried about an increased risk of recession. Is that a concern that's shared by other members of the Monetary Policy Committee?
It's not actually something that we spent time discussing explicitly. You can see that we've got a chart in the report which shows, in a sense, a band around the activity outlook. So I would say, I can only speak for myself really at this point, having voted for a 25 basis point cut. My vote was not, I should say, motivated by my concerns about a risk of recession. The other thing I would say is that actually, and this does come out in the report, our actual view on the path of activity going forward has changed really very little since May. If you actually compare what's in the report today with what was in the May report, actually on the activity front, we've really changed our view very little. Actually, it's other things that.
Just on that, if anything, it's actually slightly stronger. I mean, very slight. So we've got. I mean, look, UK economic growth is weak, right? It's weak in these numbers. We've got, I think 1.25% is the forecast for this year. That is, slightly higher than last year, slightly higher than in our last forecast, but it's not, it's not something that you'd hugely celebrate. But it's, it is. We are seeing growth, and we do actually expect it to increase further out in the forecast. Again, not particularly high rates, but we are expecting growth in that sense. I mean, the other point that I would make around weak activity is it really matters for inflation what is driving that weak activity and what is the balance between these being issues around the level of demand in the economy and the level of supply in the economy. And I suspect it will be a balance of both, but that balance really matters for the decision around inflation and rates.
And if I can just supplement what Claire said, we've got 1.25% growth that we're forecasting to the current quarter. Then we see growth over the next year, another 1.25%, and then we've got growth picking up to 1.5%. So, these are modest growth rates by historical standards, but they're positive. Obviously, there are risks around those, and as Andrew's emphasised, the risk around inflation, the upside risk around inflation has increased since May. The downside risk around activity is also more apparent. But our baseline forecast, which has not really changed actually since February, we've had quite a lot of stability in our growth and inflation forecasts, is for modest but continued growth.
Joel, and then Anna.
Joel Hills from ITV News. Governor, the government's borrowing costs have actually gone up even as you have cut interest rates. Why do you think it is that markets are charging a premium to the UK. Is it possible that investors doubt your commitment to tackling inflation? Do you think it's concerns about the government's spending plans?
I don't think so. I mean, I think, first of all, Joel, I would say if you look across this year, this calendar year, that is, and you compare the UK with actually other major countries, the moves in curves have been quite similar in some ways. So the steepening of curves that we've seen, which I think is probably what you're alluding to, that we've seen across this year is actually a phenomenon that we've seen across major government bond markets. So there isn't, I think, in that part of it, I don't think there's a particularly UK story going on.
The opening article is slightly confused. It said that the UK was actually a bit of an outlier.
Can I comment on this, Andrew? Because I think, I mean, we set out in detail on page 49 of the report that this trend upwards we've seen at the long end is absolutely common across countries. So you've seen the spread between the 30-year and the 10-year government bond yield. Since January, it's risen by 35 basis points in the UK, 40 basis points in the US, and over 50 basis points in Japan. So there is this global focus, and this may be common to what the OBR are saying, on long-term fiscal sustainability, but it is a global focus. And we also know at the long end of the curve that for different reasons in different countries, in the UK, more to do with the decline in defined benefit schemes, there's less of a natural buyer and demander for long-term government bonds. You see similar factors happening in the Netherlands, slightly different factors in Japan and the US, but all jurisdictions, particularly at the long end of the curve, are having to deal with a changed environment.
The thing I would also add is that the UK, historically has been in a somewhat different position because the UK has raised more government debt at longer maturities. Now, actually, that's a good policy. I mean, there's much to be recommended with that policy over the long term. But it does mean that the UK has, somewhat more of the UK debt stock has somewhat more of a focus on the long end of the curve.
And then Chris.
Hi, thanks. Anna Wise from Press Association. Firms are saying that higher employer taxes are weighing on growth, and trade uncertainty has dragged on investment. It seems like a fairly gloomy picture here, but you've raised your projections for GDP. So can you just explain a bit more about your reasoning here?
Sorry, raise the projections.
You've raised your outlook for GDP this year, so can you just explain?
Oh, well, that really is on data releases that we've had since the last report. I think, as Claire and I were both saying earlier, really, and actually Dave was saying as well, if you look back to even the February report, as you were saying, Dave, you really don't see much of a change in our overall, in our GDP profile. So the change in the outlook for this year on that front is really just to capture data news that we've had since the last report. It's not actually a change of view. We have not sat down and sort of said we've got a different view. Really, we're just incorporating releases, which are not very big changes.
It's very similar. The other thing is further out. Obviously, the changes in asset prices might have played a small role, but these changes it's a very small change in the forecast compared to the previous one that we did.
Chris, right there.
Chris Giles on the Financial Times. The inflation forecasts in this report are almost sort of priced to perfection. So within 2 years, you get down to a central forecast median and mode of 2%, and then it just stays there all the way to 3 years and into the future. Is this the time you are actually validating the forward curve, which has interest rates coming down to 3.5%? And is 3.5% now currently, it can change, but is it currently your view of where interest rates might settle?
Well, I'm sure Claire wants to come in. Let me start, Chris, by saying, putting into a slightly broader context, of course, that we are, and this is really part of the Bernanke changes, that we are, as he recommended, while we're still committed to producing the forecast, and that it is a committee forecast, which does distinguish us from quite a few other central banks. The centrality of that, we are building around it, as you know from what we've said and what Ben Bernanke said, we're building around it, a broader range of analysis. We used the scenarios in May and we've rolled them over and we're drawing on them again this time. So you're right in your description of the forecast, by the way. I mean, that's a fair description of it. Price to perfection obviously sets the bar quite high for for achieving it. But I would just say, I'll just come back to what I said in my opening remarks, if you don't mind, about the risks, because there are real risks. The risks are quite real and very apparent around that, frankly. And as I said in the opening remarks, the risks go both ways. There has been, I think, there is slightly more now upside inflation risk. But there is also, and I use the word direct to describe that, but there is also slightly more downside risk coming through activity, but obviously then it would come through to inflation. So I would sort of temper what you said about price to perfection with that view on risks, that there are very real risks on both sides of this.
Yeah, that's right. I don't have a lot to add. As you know, we're moving away from the forecast being the central input into the process as being one of a number of inputs. It obviously remains an important part of what we do, and we spend time thinking about it, and it's a very good baseline for the discussion alongside some of the other material that we consider around risks, around scenarios, around different models and interpretations of what could be going on. So it's it would be an over-interpretation of the forecast to try and read something Delphic into what's going on at the back end of it with respect to the inflation forecast and the market curve. I would say that the changes are not huge since last time, and they reflect different, the changes that we've seen in conditioning assumptions and data.
And just on, this is a point that comes up every year when we update our assessment of restrictiveness, but the in box A on restrictiveness, we've put in updated estimates for that you get from the different methodologies that you can use to try and work out some measure of the neutral or terminal rate, and the range of those estimates on my interpretation is, as Claire said it was a year ago when we had this similar discussion, it's in a range of 2 to 4%. Within that, MPC members have a range of views. Some MPC members have been explicit about their views of where they think this notion of R star, or what markets tend to call the terminal rate, in terms of how they're interpreting things might be. But I wouldn't draw the conclusion that you have based on that range. It's a broad range, and there are different MPC members have views, but we don't have a collective position on that.
Sue and then Ritika.
Hi, Sue Chan from The Telegraph. Could you please explain why you've downgraded your real post-tax labour income forecast to 0? Would you say that working people are under pressure, and why do you expect those pressures to intensify later this year and into next?
Look, we have... Sorry, ask it again. The post-tax...
Why did you downgrade your post-tax labour income to 0? Would you say that working people are under pressure, and what are the factors driving the downgrade, that starts this year and into next?
Look, we are anticipating falling. The increase in wages will, come down, if you like, and you can see that in our numbers. We are, obviously we have higher inflation in this forecast going forward. So in that sense, this is it is a constellation that is challenging, right, for people.
In a way, you can look at it. I think Claire's obviously right. You can look at it as the balance of the two risks we're talking about. So on the one hand, you've got slightly higher inflation. On the other hand, you've got a slightly weaker activity profile. And by the way, we've said a number of times that there isn't a huge amount of news since May. Well, the one thing that is apparent since May is that the is that pay has come in lower than we thought it would be. So the AWE has come in lower than we thought it would be. That has enabled us, and I covered this in my introduction, to say that we think the path of pay increases that we've actually had since the beginning of this year, going back to the agent survey that we did at the start of the year, is sort of solid in terms of the profile. Now, you put those two things together, you put those two risks together, you put how they translate in the past together, you sort of get the outcome you just described.
It is worth putting in context that in 2024, real post-tax labour income grew by 4.25%, and we expect it to grow by 1.5% this year. We have revised down 2026, but it's for exactly the reason that Claire has said. Inflation is slightly higher. With our forecast for the end of this year for wages is 3.75% still. But as Andrew says, it's the recent data has actually come in a bit lower. But for the year as a whole, we think wages are going to be 3.75%. But with inflation a little bit up, wages similar, you just get that mechanical effect. So I don't think you should draw any conclusions from that other than that's how the forecast works.
Ritika up at the back there. Yeah.
Ritika Gupta, CNBC. Do you think rate cuts are having a big enough impact on growth? So we tend to think that policy takes a year to 18 months to have an impact, but we're a year after the first rate cut. We've had 5 since then. I'm thinking of some areas like the mortgage market, for instance. Do you think that we're actually continuing to see the impacts of tightening even as policy is easing?
Well, a couple of things on that. It's a good question. So, of course, to make that judgment, you'd have to sort of form a view on what the path of growth would have been had we obviously not changed interest rates to assess how much. But the second thing I'd say is I think there are 2 areas to look at, which, and there are obviously 2 very central areas actually to this question, to in a sense describe the answer to your question, and that's consumption and investment. So start with consumption. I mean, it is the case, and we describe it in the report, and I refer to it in my remarks, that the saving rate has been higher now for longer than we expected it to be. And of course, the consequence of that is, given real incomes, given Sue's question, is we've got a consumption path that's weaker than we thought it would be, which obviously feeds through to growth, to your point. So this question about why the savings rate remains higher than we thought it would be, we do expect it to, we continue to expect it to, in a sense, come back to more normal levels, but it has remained higher. We've offered some views in the report as to why it may be that this is drawing on survey evidence. Turning to investment, business investment, I mean, again, I think there I would actually, in a sense, draw on the world situation more, because one of the very clear messages we get, and we get it when I go around the country talking to businesses, is that there is, of course, a higher level of uncertainty at the moment. It may not be quite as high as it was in May, but there is it is still elevated relative to normal levels. And, of course, that tends to map through into businesses responding to greater uncertainty by delaying investment decisions. That's a reasonably well-established feature. And I certainly pick that up when I go around the country. People saying, look, there is much higher level of uncertainty at the moment. Given that many investment decisions are irreversible once you take them, the value of waiting therefore goes up, and that is what is happening. So I think both of those things, in a sense, are stories that contribute to helping to explain what's going on that you described in your question.
Mm-hmm. But just to add, I mean, as you said, we know there are lags in the system. You can see in the data, though, some of the impacts. So, mortgage rates have come down, right? And they've come down quite a lot. Similarly, if you look at, and we've spent a lot of time looking at why are people saving, the proportion of people saving because of high interest rates has also come down. So you are seeing these effects.
Francine and then Isha.
Thank you so much. Governor, given the closeness of UK and US markets, how worried are you about the constant attack from President Trump on Jay Powell, but also the firing of the jobs number person?
Well, Francine, I obviously don't comment on events in the US and the policies of the US administration, because that is really for the US. I've said in interviews I've given actually in the US As you know, Jay Powell is a friend of mine. Obviously, we are very close. We work very closely together. And I'll say this again, he is a man of the utmost integrity. I know him very well. He's a man of the utmost integrity. So I'm really not going to comment on what's going on in the US other than to comment on somebody who obviously I do know very well and I respect very much.
Isha, just at the back.
Hi, Isha Nelson from the New York Times. You've often talked about kind of the UK being an open economy, and that leaves it a little vulnerable to external shocks. But at the moment, do you feel like the challenges to growth, the questions around the path of inflation are being primarily driven by domestic factors entirely? And just to tag on to the end of that, today we've got the implementation of lots of tariffs from President Trump. The last time we spoke about this, you said obviously it's good that the UK and the US had a deal, but what mattered for the UK was the global trade environment. Now we have quite a lot more information about what that looks like. How is that changing your perspective on what it means for the British economy? Thank you.
Yes, actually, interestingly, you've almost answered the question, actually. It is interesting because, obviously there is an enormous amount of news coming from the world economy in the broadest sense of the term. And uncertainty, as assessed, is high. It's probably not quite as high as it was in May, but it's elevated by any normal level. Obviously, we've got tariff levels that are, it's not over, obviously, as we know from even what's been happening in the last 24 hours. But they are settling, if we can use that phrase at all, that word, at higher levels than certainly for a long time in history. But you're right that, and this is a little bit of the repeat of what we had in May, but it's possibly more so actually, that having spent a lot of time obviously in the committee deliberating both on the world and the UK, I think, I certainly speak for myself, but I think I can speak for probably all of us at this point. In the end, it's UK domestic developments that are shaping inflation and the outlook for inflation more than the world. Now, the world is a very uncertain place, so don't get me wrong. The level of uncertainty is up there. Things can happen. We've obviously been through several years now of very big world economy shocks going on around us. So, our vigilance to what is going on in the world is undiminished in that sense. But it is true that, you put it well in your question, that it's actually it's the UK situation that is more the driver, we think.
Tom?
Hi, Tom Rees from Bloomberg. You made it very clear in the NPR that signs of strain in the gilt market could be worsened by QT if you're not careful. Would 100 billion run off next year in a 50-50 split between sales and redemptions? Would that be too much for gilt markets to absorb? And also, would you consider having an unequal split between the maturity buckets for the sales? Skew more towards the shorter end?
I will hand that one to Dave.
I'm afraid this is going to be one of those answers that I give versions of every year, but that's because we, since we started on the process of QT back in 2022, we have had a very clear set of staging posts. So what you've got today is, I think it's called Box B in the report, but it's an 8-page box which will probably have a relatively small but very engaged readership that will genuinely want to understand what we tend to put out at this stage. And what we put out is explaining our principles for doing, how we go about QT. Those principles haven't changed over that 3-year period. First, bank rate is the active tool for the MPC when adjusting the stance of monetary policy. Second, sales are going to be conducted so as not to disrupt the functioning of financial markets and only in appropriate market conditions. And third, to achieve that, sales have been conducted in a relatively gradual and predictable manner over a period of time. So those principles have served us well. What we've also put in the box is our latest analysis of the impact of QT a year on from the last time. So we think the cumulative effect on term premia of the QT to date is now 15 to 25 basis points. So that's up a little bit from a year ago when it was 10 to 20. That's still a modest impact, and it's obviously consistent with the principles. It's an impact that then the MPC, in using its active tool, which is bank rate, as we have used it again today, can take account of. But I think, back to the answers that Andrew and I gave earlier, we are very cognizant of developments in gilt markets, particularly at the long end. We've seen that spread between 30-year and 10-year widen in the UK market. It's a global feature, as I emphasised. And as we set out in the box, we are looking, as we always do, we're monitoring market functioning. But, to just finish, the process is that we put out our analysis now, and then we make a decision on what will be, if you like, the total reduction in the stock of asset purchases for the next QT year, which will run from October to next September. That decision will be made in September. So we've set the scene with the box today. Quite a lot of detail, quite a lot of new analysis in there, and then the decision will be made in September.
As we always do.
Maurizio and Tim.
Hi there, Maurizio Allen-Carr from City AM. The Monetary Policy Report says the government's fiscal policy is dampening growth. So would a decision to raise taxes further in the autumn, as is widely expected in the City, risk sending the UK economy into a doom loop and even further dampen growth? And just to add, the banks obviously had accusations of groupthink in the past. Is this sort of unprecedented vote today, or double vote, what does that say about the MPC as it is right now?
Sure. So two very different questions, so I'll take them completely separately. So obviously, as you know, we condition our view forward on announced fiscal policy. Obviously, the announced fiscal policy that we are conditioning on at the moment is essentially the budget and the spring statement. That's where we are. And I'm not going to speculate on whatever the government may or may not do in the period to come. That is obviously for the government. We will obviously take it into account when it's announced and not before. So that's a very, very standard operating procedure and rule that we have, and that's how we will do it. Turning to the vote, you're right. I mean, this is the first time that we had two votes. Just to be very clear on this, because it's set out in the minutes I think, very clearly, the distribution was 4 members. In the first vote, the distribution was 4 members preferring to hold at 4.25, 4 members preferring a 25 basis point cut, and 1 member preferring a cut of 50 basis points. Now, I'll just explain. So, obviously, there is a provision in the legislation for a casting vote. My view on that, and the view I said very clearly to the committee, is that I think that provision, and it has been used at least once, is a provision that is there when the committee, for whatever reason, doesn't have 9 members. It has an even number of members. And so it is possible in that situation, of course, to have a tie. That's not the case here. I mean, it's clear that with that distribution of votes, that the balance of the distribution was to cut rather than to hold. And so I thought it was appropriate, therefore, that we had a second vote. And we discussed this, by the way. We had a second vote, which, of course, was a constrained vote in that sense, and saying to the committee, look, we can see where the balance is, we can see where the distribution is. So I think it's appropriate now to have a second vote, because it's critical that, obviously, we reach a decision. We're here to reach decisions and to implement them. But from that, I think it's clear that the sensible second vote is to choose between the two, obviously, most, in a sense, popular in the first round outcomes, to hold or to cut by 25. That's what we did, and that's where you got the clear outcome of the second vote. Now, I think that's a sensible interpretation of the legislation and the MPC's procedures and find that. But what I want to emphasise is that even though we had 2 votes, just to emphasise, what really matters is the decision and the outcome, and that's clear.
Go ahead, Tim, and then Delphine.
Thank you. Tim Wallace of the Daily Telegraph. We've heard quite a lot about the impact of the national insurance increase, the living wage changes. What's your assessment so far of the impact of the Employment Rights Bill on businesses, on workers, on inflation and so on the path of monetary policy?
Happy to. I mean, very little because we don't know the detail of it, and businesses don't, and so it we haven't got an impact of it. It doesn't feature in our forecast. We will obviously, as we find out what once confirmed, we will talk to and use our agency network to find out how businesses are responding to it. But until we know what it is, we can't in fact.
It really hasn't featured in our discussions.
Thanks. So, as you set out in the report, the UK seems to be looking both at a bigger near-term rise in inflation than other countries, partly due to the tax increases from April that are still feeding through, but also a longer-lasting period of high inflation, which has obviously been a feature for quite some time. What is it you think is unusual about the UK? Is it something about fiscal policy? Is it something about the labour market? Or is it that inflation expectations have drifted?
Well, I want to come in. I think, Delphine, you have to look at both the sort of what I might call the demand side and the supply side here. Because, one of the important questions, obviously, is the sort of the constraints coming from the supply side, and particularly in the labour market. So we have seen a fall in participation over the last, since COVID, really, actually, in terms of labour market participation. Now, of course, there's all sorts of uncertainty around this, given the issues with the LFS. So we have to look carefully at all of this. And unfortunately, participation is one area where we're almost solely dependent on the LFS. It's the one area where you can't easily substitute with other things. But we have seen that tightening. We do also describe in the report, and Claire may want to talk about we've changed, not because we've taken a judgment, it's just that the ONS has come out with new profiles. We've changed the population profile as well. So that's a backdrop to it, really, in terms of the labour market, I would say.
Yeah, I mean, I would supplement that. It's very hard to judge the level of supply in the economy. And that is clearly part of what is going on here. As Andrew said, there's a set of questions about the labour market, particularly around participation and what structural changes we may have seen, as well as what's going on cyclically there. We have in this report actually taken on the updated figures from the ONS about population. So they've estimated a lower working age population. We've taken on that in this report. So that reduces the labour force by, I think it's 0.7%. In terms of the level at the end of the forecast, that has an impact as well through this. But I mean, it's not a huge change, but it's in there. So, in understanding what's going on with the UK, you do have to think about these questions about both supply and demand, and it's not a totally straightforward picture.
It's quite complicated because you look at it, the back data has been revised, and the forward-looking profile has been revised as well. So it's quite complicated to parse these things out.
But I think the question is a really important one. I mean, from my perspective, just over a year ago, I was thinking that in inflation terms, we look more like a laggard than an outlier. But the nature of the persistence of inflation, it surprised me, and I think it has. It does lead you into these questions that Andrew and Claire, that we're all grappling with. How much is there a difference in terms of the UK's supply side, the way we've responded to a set of global shocks, and how particularly that manifestation of both increased persistence compared to what our conventional models would suggest. We have this suite of wage models, and wages have stayed above the swathe that you'd get from that suite of models. What does that tell you about changes in the wage setting, but also the price setting behaviour? And it does tend to come back to these kind of supply side factors, because most of the demand factors will be common across economies, whereas for us it's more, we've been hit by the shocks, and then how has the economy responded to those? So I think it is we clearly see that that's a kind of, it's not just a challenge for monetary policy makers. It obviously is a particular challenge for us because our job is to get inflation back to target. But I think it is also something the OBR are grappling with, something that understandably the government is grappling with when it's with its growth agenda, because it wants to move out of this period of very subdued growth, very subdued supply side growth, which, if you like, is the speed limit on the UK economy at the moment.
I would though just remind against this sort of point which we've all said, which is genuine questions around sort of the structural side of the labour supply story. Just to remind, obviously, this, as I said earlier, if I had to sort of pick out a piece of news in the data since May, it's that pay has come in lower than we thought it would be. So this is a tension.
Philip and Dave.
Hi, Philip Inman from The Guardian. Given everything you've just said, Dave, would it not be the case that the British public would be rather confused that you're cutting rates today with the persistence of inflation that you've just outlined, regardless of all the underlying cross currents that you also described? Surely they would be expecting you to hold rates today. They want you to tackle inflation. And aren't you going to just collectively encourage wage rises now? Aren't those workers now going to think, well, we've got inflation going through to next year, it's not going to be below 3% next year, we need to go and get higher wages, not lower?
I'm sure others will want to come in, but if I can start, I think it's really, I take you back to a kind of couple of things that Andrew said in his opening remarks. One is that the underlying disinflation process is continuing. We've been talking about this persistence in inflation for the best part of a couple of years. Our judgments on that persistence haven't changed, but that persistence, certainly compared to my expectations 18 months ago, it has continued to manifest itself. But we are still seeing the underlying disinflation process continue. Andrew's just talked about wages actually coming in slightly below our expectations. He also had a chart that showed services inflation once you strip out administered prices, still on a declining trend. The other thing to bear in mind is that we've reduced bank rate today, but we think that policy is still restrictive, and that's about past policy. We only started cutting rates a year ago. Before that, we had policy at 5.25% for a year. So policy remains restrictive, both in terms of past tightness of policy feeding through, and also when you take account of what's priced into the yield curve in the sense of bank rate is now at 4%. It's not like if you look at where official rates are in the euro area, they're much, much lower. So it's a question about how what I was trying to talk about is a kind of ongoing puzzle, but you then have to put that in the context of how we've been grappling with those challenging issues in the economy over the last couple of years.
Dave.
Thank you, David Robbins from Market News. Just a quick question on Bernanke and the progress, or lack of it. In May, we had at least some two scenarios with illustrations. You've got a reference to the upside one again here, and you do reference it. But we haven't come up with another alternative downside scenario, if I understand it rightly. That one had trade uncertainty in there. You seem to de-emphasize that. And there was also hot debate last time about whether alternative scenarios need alternative rate paths. Are these still subjects of internal debate? Do you actually know where you're going on this? And is it just a case of taking time to get there, or is it still all up in the air? Thank you.
So look, thanks for the question. I mean, we're continuing to progress the work on implementing our changes in response to Bernanke. We did, as you say, we had 2 scenarios in May. We used them again this time round in our policy discussions, in our debates, and as we've said, the upside scenario for that time, which was a higher inflation persistent scenario, felt pretty relevant and actually was an important part of the discussion in helping us sort of tease out what could that look like and what would the implications be. So we've done that. I mean, we also continue to do lots of other things that are going on in the background and actually are a really critical part of delivering this. So, I could talk for hours about delivering major IT reforms, but, we are building a new data platform that we are implementing from the middle of next year. We hope to be moving some of the big parts of our infrastructure onto it, the forecasts, the scenarios, that will allow us to do an awful lot of more nimble analysis, automate more analysis, those sorts of things. Now, it's not exciting press conference type stuff. It's really important, but, it's pretty methodical work to change IT systems, for example. So, all of that is going on in the background. We've also done a lot of some other things that, you will have seen publicly, publishing some more papers, like research papers on our models. For example, we've had a couple of conferences, those sorts of things. So, the work is ongoing on it. We said it was going to take some time, and we are thinking actively about actually how we should change our comms as well as part of that. So, it's ongoing. We never said it would be super quick. We are, the scenarios we have built, we are using, and they are changing the way in which, you won't see it, but the policy debate and discussion is one that, now has a much richer and more varied series of inputs going into it and much more discussion of differences in policy across the committee, which, as you can see from the vote, there are lots of differences of views about many of the things that you've raised in this press conference and beyond, and on those sorts of things, having a wider range of inputs that allows us to explore some of these in a bit more detail is proving useful, but we're learning as we go.
Ryan.
Thank you. Ryan Savey from The Sun. The government regularly talks about driving up living standards, but with low growth and productivity issues sort of more widely. Do you feel like they're on track, or what has actually led you to see that living standards may rise?
Well, I said before, I strongly support, by the way, both this government and previous government actually, for the emphasis on growth and on productivity. I think it's critically important for all sorts of reasons. Actually, it's important for monetary policy, but it goes obviously much beyond that. And I think your question was sort of phrased in those terms, and you're right in that respect. So I strongly support that. I think the government's got a number of reform proposals in its policy agenda there, which I think are all very sensible things. And I would just strongly say that we need to be very focused on reforms and changes that will raise the potential growth rate of the economy, and that is really about raising productivity growth. This is critical because, I've said it before, I'll say it again, if you look over history, what moves the dial on growth tends to be big shifts in productivity growth, which don't happen frequently because they usually require some form of sort of quite, big breakthrough on sort of technology and so on. But obviously capturing that and making sure it's implemented in the economy and therefore benefits living standards is absolutely critical. So I strongly support the government, as I say, as I did the previous government, actually. I think this is not a political point at all. It's critically important.
Last question, Subhan.
Thank you. Subhan Abdullah from Reuters. Governor, do you think that the Low Pay Commission's new recommendation for a 4.1% pay rise in a minimum wage in 2026 will make it harder to get inflation back to target?
Well, we always say we take into account announced policies. So, by the way, that's obviously not an announced policy yet. I mean, the process is ongoing and underway. And we will take it into account when it comes out. I don't think it's appropriate for us to offer any judgment on what that should be, because frankly it's a public policy decision which takes on board many things, many aspects. I will of course say that I think it's important that the inflation price stability actually and the benefits of that for the cost of living feature in the set of issues that are taken into account in considering that judgment. But that's as far as I will go, because I think that's as far as it's appropriate for the Bank of England to go in that respect, to just remind that price stability is important. But there are many other considerations. I fully recognise that.
Thanks very much, everyone.
Thank you, and have good holidays if you're about to go on holiday.